Across, we have Rahul Singh, CIO Equities at Tata Asset Management, joining us to give us his perspective on how he's looking at markets. Rahul, talk to us about what the possible triggers for this market could be. Of course, the positive reaction coming in with regard to how President Trump is addressing the Greenland issue, if I can call it that, is having a rub-off effect on markets. Also, the way in which he's addressing NATO allies is also having a rub-off effect on markets. But domestically, are you seeing the earnings cycle kick through starting Q4? Is that what you are likely penciling in?
Yes, I think the earnings season has started by and large quite fine actually, because the numbers are either in line or better than expectations. I think the core drivers of earnings, whether it's credit growth, consumption, and the likely impact of GST on on the outlooks which the companies are painting for next year. I think all those things are going as per plan. Even IT is kind of in pockets managing to surprise. So to that extent, I think the earnings season is turning out to be quite fine. I think the bigger issue is obviously on the macro and how the USD INR is behaving. I think that is creating a little bit of nervousness, because a large part of flows obviously tracks that, and therefore tends to have a knee-jerk reaction to how the rupee is behaving. So I think the first trigger for the market is not going to be budget, not going to be earnings. It's going to be stability in rupee, because rupees decline in the even when crude has not really gone up, is something which I think needs to be watched. So I think that's the first sign, and it kind of creates a vicious circle. So that circle needs to be broken for any kind of valuation discussion or earnings discussion to actually have more relevance, because the valuations are becoming normal. We have looked at mid and small cap valuations also compared to large cap. There has been a cooling off since 2024. Nifty P itself has come down from 22.5, 23 times forward in middle of 2024 to now close to 20 times. So everything is, and earnings are likely to go up. So I think all those things are falling in place, and now the macro has to fall in place. It used to be the other way around. The macro used to be in place, and the micro, which is the earnings, used to disappoint. Now it's at least temporarily, it's the other way around.
Okay, very interesting take over there, Rahul. Hi, morning. Given the kind of consolidation that we've seen in the market in the last 12 to 18 months, do you also see this translating into valuation comfort now, or at least valuation comfort compared to where the Nifty was trading earlier? And does that make some very highly valued sectors more attractive to you now?
Yeah, definitely. I mentioned that there are still pockets where there is overvaluation, but they are now more stock specific. I think from a sectoral level, a lot of the thematic sectors which did well, like defense, manufacturing, capital goods, we have seen significant correction from the tops. And at individual stocks, some of those names are becoming more reasonable. I won't say attractive, because attractive means you have to be trading below your 10-year average valuations. We don't still see that, but I think definitely more attractive than they were in 2024, and that is cutting across large cap, mid cap, small cap. As I mentioned, the mid and small cap premium to Nifty 50 valuations have also cooled off a little bit. Actually cooled off reasonably substantially from 2024. Still not in a zone where we would completely swing from large cap to mid and small, but definitely something which now deserves a closer look.
Okay. Rahul, if one were to take the 2-year view, would you therefore say that maybe mid and small is the more attractive zone to be in if an investor is looking at the 2-year view? Because the growth there will always be at a faster pace, and therefore, if not the 1 year, the 2-year, is that the better place to be at?
Well, the longer you stretch that timeline, you make it 5 years, I will say yes, definitely. You make it 2 years, I'm kind of in the neutralish zone. In a 1 year zone, it's still looking like large caps can do better than a mid and small. So the longer you stretch, and we had done this analysis that if you look at a 10-15 year history, a small and mid cap will always, small and mid cap as a category has generated 1.5-2% more than a flexi cap or a multi cap category. So the longer you stretch it, what you're saying becomes true. And I think in 2024, I would not have said it, but now at least the valuations are normalizing. So at least even if you take a 5-year view, I can say that what you're saying will turn out to be true. 1 and 2 years becomes little tricky because large caps are also delivering earnings growth next year. So therefore, and I think there's been more selling in large caps. It's become more, I won't say under owned, but underweight. So therefore, there could be that swing towards large cap, which could extend beyond 1 year. But if you take a slightly longer view, like I said, 5 years, definitely mid and small caps will generate alpha over large caps.
Rahul, the commodity cycle has played out very, very favorably for companies, for stocks. Where are we at this point? Do you expect this to be more of a multi-year upswing, or have we normalized and now returns will start to taper, or do we expect an underperformance going forward?
I presume you mean the industrial commodities and not bullion. So on the industrial commodities, I think what is happening is at the macro level, China is advocating anti-involution strategies where they want to, obviously support the prices or reinflate the economy. I think these are longer-term trends. I won't say that we are in the middle, maybe of that cycle, maybe somewhere. We are definitely not in the late stage. We are not in the early stage either. So I think we've crossed that early stage, and I think these things when they change, they remain like that for a fairly long period of time. So it's difficult to put a timeline to it, but I would say that it's probably begun, and we are somewhere in the middle of that period.
Okay, and Rahul, very quickly, if you can tell us what is your stance on sectors like IT, given the fall in rupee, and real estate that is continuing to see very intense pressure very lately. Any thoughts on both of these?
Yeah, I think IT we are less underweight than what we used to be 1 year back, but again, it's become more stock specific. Earlier, it used to behave more at a sector level. Now the behavior is more stock specific because the sector itself, the growth pickup is likely to be very tepid. I mean, if you had 2-3% growth, maybe it will be 5% next year. So within that, the companies will have a lot of divergence in growth, and we saw that in the results season, which has happened so far this quarter. And I think the same trend will continue next 1 year. So the effort there now is to look at more individual stocks rather than the sector as a whole. As far as real estate is concerned, I think the pack has derated significantly, and it's become more attractive definitely than 2024, but even compared to 2025. And there are companies and there are stocks which are trading below their NAV now, and I'm not even taking the land value, but below the NAV of the ongoing plus the pipeline projects.
Sure.
So definitely somewhere where we are turning slightly more constructive at these valuations.
Okay. It's so good to have you on the show today, Rahul. Thank you so much for your time. Very quickly, we were shifting